Risk Parity framework is a framework developed by Mr. Ray Dalio, a leading hedge fund manager of Bridgewaters. So what he has developed here is he has maximized the return of the portfolio and minimized the risk. So when we talk of risk, it's all about drawdown, how much the portfolio can lose money in different economic cycles. So we all know that we invest in different asset classes. It might be equities, debt and gold. And in different economic cycles, like in a bull market, the equities will outperform, whereas the gold will underperform and might stabilize the returns, whereas debt will be stable in that situation. Whereas in case of a bear market, we know that equities will underperform grossly. And in this situation, gold will outperform. So how do we maximize our returns in different economic cycles? By reducing the risk. So what we try to do here is, based on the economic cycles, we give the weightages to different asset classes accordingly. So in a bull market, we'll be overweight on equities, we'll reduce our weight on gold and be stable on debt. Whereas in a bear market, we'll be increasing our allocation to the gold, reduce our allocation to equities and be stable on debt. So how do we reduce our equity exposure? We also take an arbitrage as a call here, so that we short the markets and reduce the overall exposure to the equity. So the net equity levels are below the benchmark level, so that we are still protected in the downside and we minimize the drawdown. So that's how we reduce the risk during a bear market. In a sideways market, we remain overweight on gold and silver and remain equal weight on equities and debt. Whereas in a crisis kind of situation, it's similar to a bear market, where we reduce our weightages to equities, remain overweight on gold and overweight on debt at that point of time.